Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. As highlighted in the title of this video, we've seen one of the largest outflows from active equities from this data set going back to 2017. Now, this is the largest outflow we've seen since December of 2021, which clearly wasn't such a good moment to be in the market and was followed by multiple rounds of selling in the market. So the question is, are we in a similar spot right now? Is the big smart money right now getting out of the market before another big rug pull just like we saw throughout 2022? We have the yield curve that's deeply inverted, signaling that a recession is coming. And we have the Federal Reserve that is still pursuing one of the fastest and most aggressive hiking cycles in financial history. The federal funds rate is now at levels not seen since 2007. So in this video, I'm going to be showing you an array of different charts that will help you understand what this actually means for the market today, what other investors are currently doing with their portfolios, how they are currently positioned, and more importantly, what it means for the markets and for you. Now, without further ado, let's get right into it. So to bring a little bit of context about why having a contrarian approach, a contrarian mindset when investing is important. If everyone is aware of the same development, it's probably priced into the market, priced in for perfection. So for example, as I'm showing you this chart, if most investors are optimistic on technology stocks because there's a massive pandemic and these technology stocks like Amazon, Facebook, Google are set to benefit from the fact that everybody's at home on their computers, well, that could be the very moment that those stocks become unattractive because they've been bid up so high. That's exactly what we saw back here in 2020. You can see this is a measure of the optimism in technology stocks, and you can see the optimism went through the roof right here in September of 2020. Now, of course, they continued moving higher after that, but when you compare the performance of technology stocks against the SP500, September of 2020 was right here at the peak of the technology pandemic-fueled bubble. So as both hedge funds and retail investors were overweight on technology stocks throughout that period, the only thing they could do was sell, bringing these tech stocks lower in the months that followed. And in fact, that works pretty well to time the market as well, not just individual sectors like technology, but also the market. And you can see this chart here, and I apologize for the poor quality of this chart. This is how fund managers are positioned in stocks relative to bonds. Now, typically, fund managers are invested in stocks. Typically, they are overweight in equities, overweight in the stock market, because that's what generally drives the returns around portfolios. And if fund managers don't post attractive returns for their clients, well, their clients are probably going to leave them for another fund that's posting better returns. So you can see right now, December of 2022, so last month, we see that fund managers are significantly underweight in the stock market for the first time since March of 2009. They were also briefly underweight in May of 2020. By the way, if you're so far enjoying this video, don't forget to click on the like button down below. If you're getting value from this video, it changes absolutely everything for the channel if you take those couple of seconds to smash the like button. Now, both of these periods, objectively, this was March 2009, May of 2020 was around here. So both of these periods were attractive moments to be overweight in equities, to be making a contrarian bet against fund managers. Now, of course, this is to be taken with a grain of salt. And you can see we had multiple months leading up to March 2009 where fund managers were underweight in stocks. They really started to get underweight in mid-2008, which was around here. So this is not a perfect timing indicator, but I'm going to show you something that looks a little bit more like a perfect timing indicator in just a second. But if we just step back a minute and think about what this means, well, it means that, again, if fund managers are underweight in stocks and the majority of the time they are overweight in stocks, well, that leaves a lot more room for buying pressure than selling pressure. That's just from a pure, objective, quantitative standpoint. If you're not trying to predict what the macro environment is going to look like, if you're not trying to predict that there's going to be a financial crisis or that inflation is going to come back up again, which could all be things that continue leading the market down and make fund managers stay underweight for an extended period of time, time, just like they did throughout 2008 and the beginning of 2009. But all else being equal, if you're not trying to predict the macro environment and you're just trying to be contrarian, fund managers have more room to buy stocks and bid them up higher than sell. Now, what I wanted to also show you in this video was the large trader call buying, which I saw this last week and I was absolutely shocked by it. This is basically a representation of how bullish big guys are on the market. And so you can see here throughout 2021, of course, large traders were buying calls like there's no tomorrow. And even in the first half of 2022. So a lot of bullishness in the market here in that first half of 2022. But you can see more recently, even though since June of 2022, we're actually up since then. Right, and I can show you that on this chart here. Since June of 2022, the market is up 10% since that moment. Look at what's been happening to the sentiment from large traders. Well, it's been dropping like a stone. They've been buying a lot less calls, getting a lot more fearful, a lot more concerned about the market environment than they were back in June. So this, while it's not perfect, it's another way of telling me that there is buying power right here as we're seeing this indicator collapse to 0.25, which it hasn't tagged since actually 2016, right here, right before Trump got elected, right here, and then before that was 2015, right after that quick drop in the market. I can quickly zoom out for you to show you some of those other moments. 2011 at the trough of this correction, 2009 here on this small correction right there. Now let's quickly zoom into the two bear markets and see how useful this indicator was. Now you can see we had one reading here in 2007 right there before a move up in the market. Although it was around the very top of the market, it was still right before a considerable rally. And again right here in 2008, right before this bull trap. So these extreme readings, they don't happen very often, and it does tell you there's a huge amount of concern in the market. And we can see the same thing for large trader put buying. So the number of large traders that are betting on the market to go down, well, you can see here we've seen a spike. So right as large traders stop buying calls, they're buying a huge amount of puts, betting for the market to go down. So to me, that means there's this potential to see a short squeeze rally. The last time we saw that was actually right after the COVID bottom, as you had all of these large traders short on the market and you had this massive short squeeze relief rally. Now, of course, this is, again, to be taken with a grain of salt. While these spikes are pretty good indicators of short-term moves, you can see here the general sentiment in the market around the 2008 top before the big crash of the financial crisis. Sentiment was bearish. Large traders were buying a lot of puts on the market throughout this time. And so you could argue that we're seeing kind of the same type of building up of concerns in the market that we had leading up to the 2008 top, where more and more big guys, so large traders, these are smart people. Just because we're trying to bet against them doesn't mean we think that we're smarter than them. These are players in the market that are seeing more and more concern, more and more potential for downside. But these excessive spikes can be taken advantage of in a contrarian way. Now, if you want to see how that translates into the specific levels, specific trades that we're looking at with the support levels we're looking at for entries, resistance levels for exits, the specific targets that we have for all the trades that we have in our model portfolio, you can grab yourself the free trial that you can have access to for 7 days. Everything we do day in, day out is completely centered around providing the best service for you guys, giving you the highest quality information, the highest quality trades, making sure you're taking advantage of the volatile market conditions that can be incredibly profitable. Of course, it's not all green lights in 2023. There's very likely going to be some tougher times ahead in the second half of 2023 and the first half of 2024. And so we're increasingly going to be looking to prepare for that. Now, I hope you guys enjoyed this video. If you did, don't forget to smash the like button and click on the subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.